Hey guys, welcome back to the channel. Robert here. Private mortgage insurance has received a scarlet letter, a negative reputation, in my opinion, and it really shouldn't. And so, in this video, I'm going to explain what it is on a 10,000-foot level, but in a layman's terms. And then hopefully you can understand, number one, how to not have to have private mortgage insurance if you're buying a residential property. Number two, understand and appreciate the private mortgage insurance. And then lastly, different loan types, if private mortgage insurance is applicable or not. Before we get into that, take a few seconds, hit that like, subscribe, and notification button. It really helps out the channel and I appreciate it in advance. Also, I'm a lender. So if you need help getting onto the residential property ladder, my contact information is in the description below. Now let's get into the video. Took the opportunity to make a couple of scribble notes before we got too far along in the video because I don't want to lose you. But private mortgage insurance, as I have highlighted here in number one, it helps you, me, anyone that's looking to purchase a residential real estate. That's a single family, duplex, triplex, fourplex, that we're going to live in one of the units as a primary residence. It helps us get into these properties without having to put down a 20% down payment plus your closing costs. So from that aspect, private mortgage insurance is not the devil. It's a tool that allows you to leverage more. Now, I get where a lot of people lament about it, but a lot of people complain about a lot of things today. And when you ask them if they understand, the answer is no. Now you have a 10,000-foot view of what private mortgage insurance allows. Secondly, PMI, private mortgage insurance, is associated with conventional loans. When we go to the government side of things, a government loan is anything that is backed up by the full faith of the United States government, or we the people. That would be FHA, VA, or USDA. FHA loans have the equivalent of private mortgage insurance, but we call it mortgage premium insurance. Same concept. The deal is these monies are going to be collected and put in some coffers, an account, to help mitigate any losses that happen. Because if you think about it, the more money you borrow, the greater the risk. Same thing with the interest rate. That's the concept. To be a good steward, in theory, what FHA does is say, okay, when you're buying a home and you only have to put as a down payment 3.5%, we're going to take a percentage of that money in the form of a monthly premium insurance, and we're going to put those monies to the side so that, like during the pandemic, a lot of folks that had FHA or government insured loans didn't lose their homes. There were a lot of programs, so on and so forth. Or if foreclosure has to happen, the end investor, which is key, that's the person that makes the money available for you to borrow. If nothing is getting sold, if no debt is being created, then nothing happens. That end investor has to be made whole. That's what those monies are for. With FHA, monthly premium insurance coupled with a funding fee. So FHA hits you with two. There's an upfront funding fee based upon the loan to value, how much money you're borrowing or how much you're putting down. That's FHA and how that works. The next government loan that I want to hit that has a insurance component to it is USDA. The USDA home loan, for those that qualify for it, doesn't have what we would call a monthly insurance premium, but there's a funding fee. There's an upfront funding fee that's associated with the loan and an annual fee that's paid monthly. And as you can tell, these different programs have different names for the insurance, but for the most part, the understanding of what the insurance for is to allow you to put less down. So now we've gone from FHA that will require a minimum of 3.5% as a down payment to USDA where there's no down payment requirement, or stated a different way, you can borrow up to 100% of the purchase price of a home. So if you have no skin in the game or just 3.5% in the game and things get tough, the likelihood of you walking away is greater than someone that has 20% or more as a down payment. That's the concept. And for USDA as well as FHA, that's for the life of the loan. So that's something that you have to understand before you get into these loans, the insurance and how it plays into your overall finances and strategy for when you're buying a home. That's why it's very important to deal with someone that you know, like, and trust. One caveat to that is on FHA loans, if you put 10% down, then your mortgage insurance premium will fall off the loan in 11 years, say 11 and a half years. But USDA is for the life of the loan, and FHA for the most part, because most people are putting the 3.5% down. That's why they call it a first-time home buyer loan. Not really a first-time home buyer loan. Anybody could get it, but you're going to have that mortgage insurance premium that you're paying monthly, and then that upfront that you paid that one time at the time of closing. Those are very important things to understand. The only way to get rid of those things is for you to refinance. Most people that do a USDA loan or FHA loan, if you're doing it with the mindset that, hey, I'm trying to get in with the least amount possible, but somewhere down the line, we want to refinance when it makes sense, either to cut the term or interest rates come down where I can save some money monthly. More importantly, get rid of the MIP or the annual with USDA. That's how you want to think about refinancing. But most people that get into these things, again, they stay there. All more the reason to deal with somebody that is knowledgeable, and that's not just a salesperson putting you into a loan, going on to the next. Because you really have to manage these things. In my professional opinion, especially your first home, you should keep it. And so the goal should be, I stretched the payment out initially over 30 years. Now what's our strategy to pay it off within 7 to 15 years? Now, the only loan that does not have a private mortgage insurance component, and the reason I say it's the best loan out, is the VA loan. Depending on your eligibility and your disability status, if you have a 10% or greater disability rating, you don't have to pay the upfront funding fee, we'll call it like that, which is a percentage of the loan that you're dealing with. And so there's no monthly private mortgage insurance, and you can finance 100% the purchase price. And there's also a lot of liberties and leeway for the seller to help you get into the home as well when it comes to your actual closing costs. But as far as the purchase price is 100%, just like the USDA. So there you have it. I don't want to get too deep into the woods on these things. I just wanted to give you an idea of what private mortgage insurance is, or a why for it, and from a 10,000 foot view, how each loan type handles the insurance. So if you're someone out there that's saying, hey, Robert, you know what? I want to go further to understand not only how much I truly can afford in a home purchase, but what the best loan type would be for me based upon my individual or family situation. We would love to have a conversation with you. Contact information is in the description of this video below. 15 minutes. First one is free. It's on me. Let's talk. Let's see if we can potentially work together. My time is up, but I thank you for yours. As I always say, guys, let's be good to one another. Let grace abound. Watch these next 2 videos. It'll help you on your journey to home ownership, successful home ownership. And for the rest of you, until the next time, indeed, y'all stay blessed.